So as a quick introduction, while we get everybody up on the podium, Dhanpal Javeri is the CEO of Everstone Capital. Everstone, as most people in the room would know, is one of the most successful Indian GPs in the market today. Have recently done recent close of their fund, and breadth of experience there to share with us today in terms of what to look at in terms of Indian investments. Kirti Hariharan is Deputy General Counsel at Baring, and used to be partner at Amarchand before this. So again, he has a lot of experience in terms of M&A investments into India. Webunar heads private equity at Nishit Desai and also heads our Bangalore office. And Richard's co-head of our private equity real estate practice. And any questions related to real estate, you should really catch him. Thank you.
So thank you, Pratibha. I know it's afternoon time, so people need some break at times. But after this session, there's going to be a break. This session particular will deal with the key legal, regulatory, and tax considerations for Indian investments and evolving structures for exits from India. So in the first part, we discussed fund formation, so how to give a birth to a baby, now how to maintain it, and how to go about. So this particular session will deal with evolving structures for tax-optimized entry and exits, new routes of foreign investments into India using private debt or investments, and offshore listing of Indian companies, key negotiation points in documentation like tax indemnity, reps and warranties, insurance, Foreign Corrupt Practices Act, impact of budget, of course, we discussed, but in the context of investment and exit. So I think that's the theme of this particular part of the session. And what I would like to ask is, start with Dhanpal. Welcome.
Hi, how are you?
Thank you so much for helping us, coming here and talking to us. What's your experience in India? And what are your thoughts for investing into India? Because I think they're basic questions, but I think every day it resurfaces,
No, thank you, Nishit bhai. And look, I think in one word, very, very exciting. Very exciting environment, very exciting. Clearly, there's never a dull moment, as I say. Investing in India is fun. If you talk about macro, I think a lot has already been said in terms of the, both on the political as well as the fiscal front as to what the country is undergoing at this point in time. I think both on an absolute as well as on a relative basis, India clearly stands out today as an investing destination. The governor, his various very, very decisive actions that he's taken over the last 18 months to make sure that the monetary framework of the country and the fiscal framework of the country is quite solid and robust. On the political front, the new government, which has been formed with an absolute majority, a mandate which has been won for the first time after 30 years, clearly has a fairly long-term, I would say more like a 10-year plan rather than a 5-year plan to put the country back on a high-growth track. Clearly, the challenge is all in the short term. So while we do see a lot of intent and vision at the top, how does it all translate on the ground in terms of reality, in terms of whether it be demand at the local level, whether it be the business sentiment to put more capital to work, etc. So I think this is really a very interesting time to be putting capital to work because not just from what the market as a country offers from a long-term perspective, but even from a supply of capital perspective, I think there is, as compared to 2008, far less capital available to deploy in India. Two, the overall universe of private investors has actually shrunk. There is a very clear shift towards quality. There's a very clear shift towards experience. And I think that also is driving the overall amount of capital available to put to work in India. There is also, I think, a fairly different positioning from the public market. So after a long time, we are seeing that private markets in India are trading at a discount to public markets, which is actually a good thing, which is how it should be. Private assets, being illiquid, need to be valued at a slight discount to public or listed companies. So overall, I think it's a good environment to be putting capital to work.
Thank you, Dhanpal. Just before I move on to Kirti, if those of you want to sit on this side also, there is a space. So if there is some more room, feel free to use this side as well. Kirti, we just heard from Dhanpal, about his experience and his, thoughts. What are yours, because you've done a lot of work around.
Yeah, I think as a fund, Baring has been investing in India for more than 15 years now, and we have in excess of $1 billion at work. We've probably done the largest 2 deals the country has seen at least a couple of years back in terms of Hexaware, etc. But I think I echo many of those sentiments. But the term I like to use is nervous optimism, which I think is a little different from a lot of what other people say. And obviously, everyone is optimistic. You're hearing the right noises coming up, etc. But my nervousness stems from the fact that India has never been consistent, right? At any point in time, you sort of go in and you know that there will be a curveball which will come your way. You have to sort of deal with those issues on a very real-time basis. And that is something which makes it definitely exciting. But I think people want to make money on a consistent basis. If you can take the excitement out of it, they would be very happy. I don't think they're here for the excitement. They're here to see steady returns come in. And my concern, which is where the nervousness comes in, is I think the government has, to some extent, and I'm hoping this is not true, but they may have overpromised and underdeliver. They may end up underdelivering. You always want to be in the reverse situation where they underpromise and overdeliver. And now I think the pressure is sort of back on them to actually start doing things a little quickly. And I'm just hoping that that doesn't result in them making any mistakes, which then have to be unwound. That's really my thought on how the market will evolve now.
So you're optimistically nervous, and he's nervously optimistic. So can you just react to what he said?
No, I think, look, it's fair to say that, while one can expect steady returns, India does not offer returns like a bond product. It is an equity class. It is, a high beta market. And I think the distinction between performance and otherwise is really how you actually work on delivering alpha, which is really the underlying operating performance of the business itself. And that's where the devil in the detail lies. We've never had a situation, and I think we can never have a situation where we can expect macros or political leaders, etc., to deliver returns to us. A job as a private equity investor is to make sure we are in the weeds, working with the businesses, making sure we're delivering alpha, regardless of the outcomes. Now, I think when investors give us the capital, they know what risk they're taking when they're investing in India. I think what they don't want is a GP or a partner who doesn't have the ability to, I would say, sift the wheat from the chaff and be able to basically make the right decisions as to putting capital, working with the companies, and essentially delivering value and returns. So, it's a different model, and I would say from a public markets perspective, one can have, a different type of a strategy, but from a private perspective, it's really more about execution and being at the ground level.
Yeah, I think that's true. Politicians' job is to make people nervous then when they are very, very optimistic and hyper, expecting too much. And when they are too nervous, they try to bring up the sentiments. They don't worry about what is the reality around, I think. And as I understand, investment is all about psychology. So if some optimism is brought in, then people think this is going to happen in future and they begin to invest. But now Prime Minister has to control that if there are too many expectations, he has to say, please don't expect too much. It's going to take 5 years, 7 years, 10 years to, manufacturing to pick up, or even 12 years. And I think it's a very interesting job. It's a very interesting job for the leaders of the political leaders of the country. But one good thing at this point in time is after 3, 4, 5 years, we have got some degree of optimism to go forward. And at times it makes you nervous because what you read in the budget speech is something often different what is written in the finance bill. And we have now gotten used to that when finance minister makes a speech, we have to go and clap first day, and after 2, 3 days, we know there will be some hiccups in the, so it's understood that there will be some, not exactly the same thing which is spoken in the budget will happen.
Right.
So I think those who have learned that art really know how to manage that. But I think given the changing situation, it creates a lot of opportunities as well. And a new opportunity for structuring, because you have to constantly structure and restructure Indian operations from time to time or investments, because landscape is changing all the time. And because we are changing as a country as a whole, so obviously sometimes we take 1 step forward, 2 steps backward, sometimes 2 steps forward, 1 step backward, because experimentation is going on constantly. It will still take some time to settle down. But at times, some experiments we did resulted in a very negative outcome, like Vodafone, the retrospective amendment. It really taught a big lesson to our country, okay? And that is something now that is completely, rejected by the new government. They will not bring any retrospective amendment. And those are the kinds of things we are seeing because people have learned lessons from the, burns they got out of those situations. Let me ask Ruchir, what are evolving structures, for investment in India? If you can take a few moments to tell us.
I think one of the structures which I think is now reasonably old is the listed non-convertible debt structure. But I think it still remains obscure in as much as many people do not know about it, and those who know about it are still kind of apprehensive of using it. Now, what this does is, especially in companies where there is a need for cash upstreaming, let's say real assets, real estate, infrastructure, even insurance, because, cash keeps coming in and you need to upstream cash. The challenge in India is the repatriation of capital is a huge challenge. Because extinguishment of equity can either be done by a court mechanism, or if it is not done by a court mechanism, then your equity extinguishment can only be staggered, because there are only limited sources by which you can retire equity. Now, where this instrument, what we call as listed non-convertible debenture helps, is that it allows you to upstream capital in a very tax-optimized manner and without any, without any staggering. So you can upstream the entire capital at one go. Now, what is this? Basically, an Indian company can issue bonds or debentures to a non-resident. These bonds need to be listed, but they're listed on a private placement basis. So the listing is just a couple of days. We've even listed these bonds in about 2 days. And the disclosures are really just a couple of pages because it's on private placement basis. Now, these bonds can be structured in a manner that they can be called a structured equity. So there are 2 portions to this. One is the coupon and second is the redemption premium. So what you can do is that the redemption premium of the bond can be a function of whatever commercial variable you choose. So it can be a commercial variable of the cash flows which you receive in the company, EBITDA. It can be linked to the listed share price of any company or anything. So basically, it really functions in that sense as a form of structured equity, because even though it is having a downside protection, being a bond, the principal is protected, but it kind of captures the entire equity upside because it is linked to a variable. So all the cash that the company receives can be upstreamed. Where it also helps a lot is from a tax perspective. In India, when you have to upstream, let's say in the form of equity, first you would pay corporate taxes at the rate of 30%, and after paying the 30% of corporate taxes, when you distribute, let's say by way of dividends, there's again a 15% additional tax. And the distribution tax in India, the dividend tax in India is in the nature of an additional tax, which means there is no credit typically at the hands of the recipient. So there's no foreign tax credit at the hands of the foreign investor. But because this instrument is really in the nature of a bond, what happens is that whatever you pay out on, whatever upside you pay out on the bond is really a deductible for the Indian company. So not only do you not pay the 30% corporate tax or the distribution tax, you actually get deduction benefits at the Indian company level. And when you are paying the upside, it is seen as an interest in the hands of the Indian company. And depending on the depending on the country where you're coming from, let's say Singapore or Netherlands, the withholding is only 15 or 10%, which is fully creditable in the hands of the recipient. Now again, because these bonds are listed, they do not qualify as what we call as foreign direct investment. These bonds are subscribed under a separate regime called as the foreign portfolio investment regime, which is not subjected to the restrictions of foreign direct investment, which means in certain sectors like insurance, defense, real estate, there are certain conditionalities, right? And there are certain sectoral limits beyond which foreign participation is not allowed. But because this is really foreign portfolio investment or it's investment under the listed securities route, there is no such sectoral restriction here. So we've, there are instances of this being used, let's say in the insurance sector, where even though the equity component is limited to the sectoral limitation of, let's say, 26% or 49%, but the economics of up to 75 or 80% can be sucked out. And it is being used, it's being blessed. I think other challenge in India has been that, sometimes, the Indian promoters, especially in the asset-heavy asset classes like real estate, say, ROI does not mean return on investment, it means return of investment. So, the challenge is that, the foreign investors sometimes tend to get a little apprehensive of their investments. And security interest on equity investments is not possible. With this instrument, because it is really debt, you can create security interest on the immovable property, mortgages, you can create pledges, you can create whatever elements of security that you need. It can be fully secured through an onshore security trustee. So I think that really has been, I think this instrument is now increasingly becoming the most preferred route for investment, especially in the real estate infrastructure and some of the other asset-heavy asset classes and sectors where you need to upstream cash. The other interesting structure, which is kind of coming up, is the depository receipt structure. Indian companies earlier were not allowed to list in offshore capital markets unless they were listed in India. Now, last year, we changed the regime because what ultimately happened was that, where you list is really a commercial function of valuation. You cannot restrict, you cannot encourage Indian capital markets by saying that, you will not list abroad unless you list in India. And I think we lost a lot of FDI in that process. So I think we've kind of changed that in the course of last year. And now Indian companies can raise funding on offshore capital markets by way of listing their depository receipts, both sponsored and unsponsored. Now, where this helps and where this comes in pretty much in aid for the private equity players is that the PE investors can now subscribe or acquire depository receipts of an Indian unlisted company. And when those depository receipts are sold on the floor, let's say, of a US stock exchange or any other offshore stock exchange, there is no Indian tax. Today, even if you come from jurisdictions like Mauritius or Singapore, or Netherlands, where capital gains are exempt, there is still a possibility that Indian tax authorities might come back and say, you know what, you do not have adequate substance in Mauritius, or you don't have adequate substance in Singapore, and therefore I'm going to deny you tax treaty benefits. But because if you are trading in DRs, which are really capturing the underlying equity value of the Indian company, the Indian Income Tax Act itself exempts the transfer of DRs on the floor of the exchange. And all the veto rights, affirmative rights, or whatever investor protection rights are there can be pretty well enforced through the depository mechanism. We got people from BNY, etc., and we've discussed this extensively, and happy to take questions offline. But I think these are the two interesting structures which you can look at.
Interesting. Thank you so much, Ruchir. Weber, you've been doing a lot of private equity M&A transactions, and what's important to know about regulatory regime governing PE investment? If you could just...
Thanks, Nishit bhai. I think most of us know that there are three basic ways or three basic routes for investment to India. You can either do investment under the FDI route, or you can do under foreign portfolio investment route. Foreign portfolio investment route is what Ruchi talked about. We have a whole third session on foreign portfolio investment route, so that's not I will talk about. And third, you have another route which is called foreign venture capital investment route. So basically, you have three routes of making private equity investment in India. Foreign direct investment or FDI route is kind of a default route. I think most of you who would have invested in India would have looked at making investment in India in a private company of the stock market using foreign direct investment route. There are sectoral restrictions, and I will not go into that in this particular discussion. One of the interesting development which has happened in this budget is that government has actually moved the policy-making power in respect to equity, including for pricing, away from Reserve Bank of India to DIPP. So you will see a lot more active policy, and including with respect to pricing, coming from DIPP. It also kinds of reduces the two-level authority, which RBI had and a DIPP had, and often that led into a lot of disputes or internal discussions, delayed some of the policy reforms. So at least from that perspective, you will now have one power center, which is DIPP, when it comes to policy making and on pricing and other stuff. Secondly, we talked about foreign venture capital investment regime. It has been there for a long time, and it has been very popular for private equity players for investing in certain sectors. If you invest in certain sectors, there are 9 sectors. There are certain benefits which you get using FVCI regime, which you otherwise don't get using FDI regime. One of the major restriction under FDI regime is there's a pricing control, which means that whenever you invest in India, there's a minimum floor price which you need to meet. Whenever you exit from India and you sell it to an Indian buyer, there is a maximum price cap you need to meet with. Now, if you invest through an FVCI route, this pricing control are being suspended or given exemption with. So any investment made under the FVCI, and if you go for an FVCI in recent times, you will be limited to 9 sectors. Then in which case, you don't have to meet with, you don't have to worry about the pricing controls. Now what it means from you, not only it improves your exitability because you don't have to worry about pricing controls and the minimum floor and the maximum ceiling, but also it means that when you try to enforce some of the standard rights which you seek, for example, anti-dilution right, or for example, your tag rights or your drag rights, often the enforcement of anti-dilution, drag or tag rights get uncertain because of the pricing guidelines which is applicable. In a sense that if you are looking at investment, tagging your shares when promoter is selling or some other shareholder is selling, and they are offering a price, but because of pricing guidelines, they cannot offer you the same price, then your tag rights, even though is there in the agreement, may have limitation in enforcement. That typically goes away if you are investing under the FVCI regime. Same thing, other benefit is that if you're invested and your company's portfolio company is going public, typically there is 1 year pre-IPO lock-in. That is not applicable for FVCI investment if you have been investing more than 12 months. Third, and very critical, which is not something which is very well used right now, not very well known. Maybe people have not yet.
Sorry, that's a post-IPO lock-in for 1 year.
That's post-IPO lock-in for 1 year. Absolutely. So if you are invested from FVCI regime, then and you hold shares for a period of 12 months, then no post-IPO lock-in applicable to you, which means that when a lot of people are locked in and there are very free shares available, you are just one of the shareholders who can sell it in the market. So that's quite beneficial. Coming to the third benefit, you know if you're investing through a foreign direct investment route, the only instrument you can invest is either shares or fully convertible and compulsorily convertible instruments, right? And compulsorily convertible into equity shares. So either shares or equity shares based instrument. If you are a FACI registered company and you come under that route, then to certain portion of your fund, you can also invest in optionally convertible instruments. So you can kind of get into a semi-debt kind of a situation, which increases your ability to treat it like a semi-debt, plus you can convert into equity. That also increases your ability to exit at a better option. Since these are optionally convertible preference shares or optionally convertible instruments, that becomes very, very useful. So this is a very important benefit which is available to FACI regime.
Also, I think just put options, which are a huge challenge in case of FDI, are perfectly enforceable in case of FACI. There's an RBI clarification also on that.
Correct. So I was coming to put option on, but thanks for leading it. On put option, as many of you know, there was a lot of question mark on whether put option is applicable or not. Current regulation says that put option is applicable. You can enforce put option as long as there is no assured return on the put option and as long as it is done on a fair pricing. But as Ruchir said, on FACI, there won't be any restrictions since that's an FDI circular. Other thing to be kept in mind is kind of instrument which you invest. We had a New Companies Act last year. Under New Companies Act, basically what it said is that, look, if your investment is either shares or you are investing in convertible share instrument, you would be investing as a preference share, convertible preference share, what is typically used as a compulsory convertible preference share instrument. What we used to do is we used to basically have that instrument but give voting rights as if it was an equity share. So we would get the voting rights on as converted basis. Under the New Companies Act, we really cannot have a differential voting rights system unless under limited circumstances. And hence, now a compulsory convertible preference shares would not have any voting rights. So you will need to arrange you need to protect your voting rights through voting agreements and under articles. So that's the mechanism used now for giving you the voting rights. But originally, on as converted basis, voting rights are no longer applicable. Secondly, one of the other things which changed in New Companies Act was that when you are investing in a company can basically raise money either as a rights issue or a preferential allotment. And since private equity typically comes as one of the new shareholder, you would generally go under preferential allotment route. Now, preferential allotment route has a lot more complications. For example, it can be done only at a fair market valuation, which would be similar to a foreign investment, but this is also applicable if your investor is an Indian-based investor. Similarly, you have a restriction on minimum par value shares. The face value shares has to be 20,000. So total amount of face value has to be 20,000 rupees, which is very minimal when you are looking at the quantum of investment. But in a very high value company or high premium company, this can become an issue because India still has a par value or a face value concept. And a lot of time you may be investing a large number of large value in terms of amount, but per share face value may be lower, and you may not necessarily reach 20,000 rupees, even though you may be investing millions of dollars in it. So that's one thing you needs to be kept in tab. There are a lot of disclosures and filing issues which are required Sometimes portfolio companies would come and say, we don't want to go with this disclosure and filing. It is not helpful to us. And hence, let's consider rights issue. So rights issue has become a lot more popular in recent times, where instead of going through preferential route, company would say, we will do rights issue. Law allows the board to basically use the unsubscribed portion of the rights issue and allocate to anyone else they feel in good interest of the company and stakeholders. So they will basically do the rights issue. Rights issue may not be subscribed by all the shareholder or may not be subscribed at all. And then they will use the unsubscribed portion to allocate to the new private equity investor who is coming in. This has become a little popular, but recently we have seen Reserve Bank of India raising questions on whether this was really a rights issue or not. So often when you are investing in India, this question becomes very important, whether it's a preferential allotment or it's a rights issue. And sometimes you may end up making wrong choices and could lead to issues. So that's something we thought we should keep in mind. One more point, new regime is coming with respect to insider trading. So, when you're doing a pipe deal, or if you're doing a pre-IPO deal, then the insider trading norms, which are going to be applicable from 1st of May, become very relevant. On insider trading, there are 2 or 3 major changes. First, the definition of insider has been widened. So now many people who were earlier not part of the insider definition are now covered. Especially if you have investment advisor in India, or if you have someone whom you're talking to the company on a regular basis, whether you have director or not, all of those people will become insiders. So that needs to be kept in mind. Secondly, earlier only if you had an insider information or a UPSI or unpublished price-sensitive information, and you bought or sold the shares, which means you dealt with the shares or securities, then you violated the insider trading norms. Now that has been expanded. Even mere act of procuring or giving inside a UPSI to someone who is not authorized can tantamount to violation under the insider trading norms. So you don't necessarily require to buy or sell the shares or deal with the shares or securities. Even the mere process of what we call tipper and tippy, both can be covered under the new new insider trading regulations. So that is something which is critical and kept in mind. There are other regulations, but we can discuss this separately. Thank you.
Yeah, essentially what happened was we got New Companies Act in 2013, and changed a number of provisions, which I think Webunar alluded to, and we'll discuss them in a little more detail. But in the meanwhile, with this changing structures and changing landscape and uncertainty, I think some people have made a lot of money. Dhanpal, you made a lot of money in this uncertain environment. Can you just tell what is the secret of your success?
No, I think there's, both Ruchir and Weber have talked a lot about, various structures and using mechanisms to basically try and possibly improve returns, increase security, etc. But one of the things we've learned over the last, 10 years is that just being extremely conservative in this nature is, I think, what pays off in the long run. We've seen that this is a market where the 3 things, certainty, predictability, and stability, all 3 don't apply to the government, regulations, governing agencies, etc. And therefore, you will have all kinds of surprises allowed to that. So I think the less you try and finesse a structure to try and suit your short-term or what you think are long-term opportunities for you, the less likely are you to fall into trouble later. So we kind of always use terms that let's not hide behind structures to figure out how to make returns in this country and focus on really what we're supposed to do is to back the right entrepreneurs, invest in the right businesses, and work with them to actually create long-term value. So in many ways, I think that's been our kind of recipe. We are very active in our investing style. We tend to try and invest across three what we call strategies. The classic minority growth is really where we are partners in businesses, and this is a true partnership. We see ourselves as operators. We buy and own businesses and run them. And then finally, we think in India, there's always this, build versus buy concept. And then we think that kind of has worked for us well, where if it sometimes gets too expensive to buy just because that sector is the flavor of the month or the year, and you have a lot of interest and therefore just prices get bid up, India yet offers huge amount of opportunity to build new businesses. We've seen that constantly being done by aggressive entrepreneurs. We've seen now a pool of talent of professionals which have had deep experience of building businesses in India, coming out of large companies and wanting to become entrepreneurs and wanting to build scalable business opportunities. So we think where there is capital to be deployed, large-scale market opportunities to be pursued, there is a way to even just build and create value rather than just go and buy and create value.
Kirti, you made almost over $1 billion investment, you said? Over a period of time. And so you also have learned the art of being conservative and getting some rights for yourself. So could you just tell us or enumerate certain rights that you have negotiated in your PE transactions? That will be very helpful.
Sure. I think we can't claim any particular intellectual property in the rights which we have sought. I'm sure everyone in this room goes for a very similar set of protections which they want when they're investing in India. But I think this is one jurisdiction where typically governance, and when I talk about governance, I'm talking about internal governance of a company, has been a huge challenge, right? Because there is really no distinction between the company and the entrepreneur to a large extent. Entrepreneurs typically treat companies as their personal piggy bank, which is to bankroll their lifestyle to a large extent. And what you really need to do is to try and bring in some discipline into the corporation, which really helps the corporation function independently from the entrepreneur to some extent. Obviously, their identities are merged at some point in time, but what you also want to do is to make sure that this is not his backyard in which he's going to play. This is really the vehicle from which everyone is going to gain in a meaningful manner. And historically, I think we found minority investing in India to be fairly challenging. There are pitfalls, there are issues in terms of enforcement. I think the biggest issue has been more of intent than anything else. You find that if you're in certain situations where there is no intent to repay you, you're not going to get repaid. And unfortunately, the enforcement systems in India do not support that in terms of timelines, because everyone here has an investment horizon typically of 5 to 7 years. And if you go to a court in India and it's going to take you 10 years even to get interim relief, you know that that's an investment you may as well mark down sensibly and just move on in life. So I think those are the challenges which we try and deal with by trying to partner with people more efficiently. You can try and write a bunch of contracts which give you a lot of protections, but I think it's really backing the right people which has made the difference. I'm sure Dhanpal has a lot of experience in that space too, in terms of choosing your partner is much more important than writing that 80-page contract, because like I said, if it's a question of intent, it doesn't matter what you write. He's not going to be there supporting you.
No, I think Kirti is bang on in terms of, wanting to have a control bias, because this is clearly, something that we have at least experienced in our lifetime, is that if someone can do something, they will do something. So you just be prepared for that. And you really can't, I think choosing it's an art. Choosing the right partner is a real art. So many a times we rather leave that to some other people and try and to just basically focus on, getting into a control situation, because at least at that point in time, you don't have to then do a lot of guesswork, really focus on the business itself.
Yeah, and sometimes if you can't work together, you want to exit.
Yeah.
But that brings us to the next point, how do you exit? And Weber, could you just tell us a little bit about structuring exits and how do you see the use of insurance for facilitating exits?
Sure.
Yeah.
I think I will be quick here. Generally, what you've seen is a waterfall of exits you would put in your agreement, starting with IPO. IPO exits are very rare in India. We have not been very, we have not seen many IPO exits. But one promising new development which we are currently seeing is SEBI is looking at coming up with a new alternate capital raising platform, which allows basically institutional trading. That will be quite useful for knowledge-based companies and the new, high technology companies, where a company without really going and doing an onerous thing of listing or going through listing norms and going through an IPO can quickly list itself and provide exits to private equity. Now, this is again a discussion paper. We are actually helping NASSCOM to kind of fine-tune this. Hopefully, this will become a very viable opportunity to exit for a lot of private equities. The second way, which is possibly we have seen the most, is strategic sale. Again, strategic sale, if I put it up, it's either sale of private equity's own equity or sale of the whole company. Now, that's where most of the exits have happened, and I will talk about it a little later on strategic sale issues. Third is buyback or put option. I think as we just discussed a little while ago, put option is something where earlier it was not possible in terms of RBI did not permit put option by a foreign investor to Indian promoter, which is now possible, but with no IRR returns. Buyback itself, which is a put option to the company, that is possible technically, but very difficult since buyback conceptualize has restriction on how the buyback happens, from what funds it can happen, how much it can happen, and plus buyback is required to offer to the all shareholders. So really speaking, buyback has not been very popular in terms of exit. And the last one which you see in the waterfall is forced strategic sale or drag rights. Drag rights are enforceable in India. However, we have generally not seen it enforced. People really don't go to that level from enforcement. And as Dhanpal said, if you try to enforce and people will find some way of delaying it, then it becomes a very difficult mechanism or adversarial mechanism, which is not what choice of private equity for exit perspective. Having said it, coming back to the strategic sale, generally most of the exit we have seen is in terms of strategic sale. Now, when you are selling your stake, I think most important issue which we have seen is who gives reps and warranties and who gives liability. That's the major negotiation which happens. What we have seen is if you are a smaller transaction, the purchaser will ask for 100% limitation on the liability cap, which means that they would want whole amount which they are giving to basically give as a cap on the liability. If it's a large transaction that we have seen, and this is more recent trend, where that liability cap amount comes down to anywhere between 20 to 35%. But whether it is 100% or it comes down to 25 to 30%, the real question is who is going to bear it. Private equity doesn't want to bear it, especially if it is with respect to reps and warranties of the company's operation. Now, if they are the only seller, then company is not going to give any reps and warranties. If there is all the shareholders are selling, then the founder may give rep and warranties, but that's not something which he will give for everyone, since he may not have wherewithal to give it to everyone. To kind of get out of this particular situation, we have now seen a rising use of insurance, rep and warranty insurance, which basically kind of takes care of purchasers' requirement of rep and warranty and the liability on breach of rep and warranty, as well as leaves the private equity a little bit easier, that they don't need to go back and provide the indemnity to that level. So that's something which is very a trend we have seen in rising. Typical premium we have seen is about 2 to 3%, depending again on the company. Second major issue which we have seen is on tax indemnity. Tax indemnity is a major negotiation point for various things which Rajesh mentioned earlier, whether it is respect to indirect taxation or whether it is respect to what Ruchir mentioned, no substance in Mauritius. That still continues to be an important negotiation point, and that has become a little more relevant specifically now that if you are exiting a unlisted company, then the long-term capital gains required period has increased from 1 year to 3 years, which means it's a long-term capital gains for you if you're holding more than the securities for more than 3 years, as opposed to 1 year earlier, and that increases the tax requirement if you are having a short-term capital gain. Thank you.
We'll shortly move to some questions from your side, but before that, can I ask Ruchi, just take a minute to tell us what's the impact of budget? Any proposal for real estate as an asset class?
I know I exactly have a minute, so I'll be very quick. So I think one of the proposals the budget has made, and which kind of really impacts the real estate industry, is extension of SARFACI to domestic finance companies. What SARFACI means is that, domestic finance companies, or what we call as...
What's a full form of SARFACI broadly?
Yeah, so it's called Securities and Asset Reconstruction for Financial Assets Act. But what the Act really does is it allows domestic finance companies, or what we call as non-banking financial companies in India, to directly foreclose and sell the property of the borrower without going to the court. So there's no requirement to go to the court, and the property of the borrower can directly be sold. Now, this is important to know, because earlier, many years or many decades was spent by banks and other institutions trying to just prove that the borrower had a liability to pay. And once you establish the liability to pay, only then you could, invoke the mortgage and sell the property. Today, with SARFACI or with this act, you can directly sell off the property of the borrower. And this becomes important because real estate has really become more of debt play. And most of the private equity players, the GICs and the others, are kind of setting up domestic NBFCs as well, or investing into domestic non-banking financial companies for the purpose of investing into real estate. I think the other slight change that Budget 2015 has brought in is to encourage REITs, or real estate investment trust, in India. We brought in a regime about last year. We actually were involved in the drafting of the regulations. I think one of the commercial challenges that we really face, why REITs haven't really taken off, is that Indian government securities itself offer about 8.5 to 9% interest, and the yield play in REITs is only about 4 or 5%. But I think from really the one of the other challenges that we kind of face is, from a sponsor taxation perspective, because when a sponsor transfers his real estate to a REIT in exchange for units of a REIT, currently there is no capital gains tax, but there is a MAT, or a minimum alternative tax, of about 18.5%, which becomes applicable, which is kind of dissuading sponsor transfer. And when the sponsor ultimately sells the units of the REIT on the floor later on, at that stage there is no capital gains tax now. Because earlier, when the sponsor sold the units of a REIT on a floor of the exchange, even then there was a tax. So now what this budget has changed, it said, okay, now when you're selling your units on a stock exchange, there is no tax. But unfortunately, I think there are 2 or 3 aspects which are kind of still dissuading. One is this MAT, because when you get units of a REIT, at that stage there's a MAT, and the second level of MAT is when you will sell your units of a REIT on the stock exchange again. So there's two level of MATs, and I think few of the commercials and the limited availability of grade A asset, grade A office buildings or commercial complexes which are REITable is a challenge.
Yeah. Thank you so much. If there are any questions, or I would say even comments, some of you already have had some experience in India, so we would also hear from your side if there is any comment or otherwise on anything that we have done so far. So please feel free to, raise hand and give comment or questions or whatever you want to say. Anything? Yes, Arvind, thank you.
My question is, Nishit, Ruchir, and, WebHub, and also for Dhanpal, is that we're seeing NBFCs being used and are becoming popular. So, you've got KKR doing most of its deals through the NBFC route. Could you sort of expand on that? Why is that trend taking place? What are the benefits of using NBFCs by private equity funds?
Maybe I'll
Yeah.
take it and you
Go
can
ahead.
add on to it. I think, really, as always, I think the question is that what kind of structures are you looking for investments? And are you looking, because NBFCs are not just making pure debt investments. NBFCs are also making debt investments with the inbuilt ability to capture equity upside. Just the way I mentioned about listed non-convertible debentures, debt, rather than being called a structured debt, is really becoming a function of structured equity. So the KKR classic example of promoter funding, where the upside on the debt which the NBFC gives captures the captures the appreciation in the stock price of the underlying listed entity. I think those kind of structures are becoming popular. There is downside protection, there is security enforcement. So I think all this ensures, some kind of equity upside plus protection. At the end of it, if a promoter does not have money, there is no way you can choose it. But I think where it really helps is that in a situation where someone has money but doesn't want to pay, I think the NBFC, this kind of security enforcement really help you adequate protections.
Can I address that question differently and more from a markets perspective? And I think if you look at the structure of the credit markets in India, you've got the banking sector, which today controls more than 80% of all credit outstanding to corporate borrowers in India. The banking sector is substantially government-owned. 75% of all banks, assets in India are controlled by government-owned banks. And the central bank essentially runs the entire risk on these bank balance sheets largely through diktat. So they tell these banks what they can or can't do. And every time they see systemic risk in certain sectors or certain types of assets, they basically start governing that through the diktat program. The two asset classes which globally banking sector has huge exposure to is equities and real estate. And these are the very two asset classes in India where the banking sector has severe restrictions on what exposure they can take on their balance sheet. That juxtaposed against a market where over the last 10 years, both the capital markets and real estate markets in India have grown anywhere from 10-folds plus, has a huge kind of, I would say, ocean of opportunity for non-banking financial companies to offer credit to these forms of, I would say, credit against these assets. So a lot of what you're seeing in the corporate lending space, where the corporate/borrower cannot go to the banking system, there is an opportunity for non-banking finance companies to basically play that market. The other issue is what Ruchir talked about, which is really using debt as a form, as a quasi, I would say, as an alternate form for, securing your equity. It's more limited. I think there are other ways to play it other than through an NBFC. He talked about the listed debentures, so a lot of foreign investors are using listed debentures as a way to play that. But I would say primarily a lot of the NBFC activity in corporate lending you see is largely around this opportunity.
Excellent. I think, excellent. Thank you, Dhanpal. I think I must compliment this panel. We are very much on time, just about a couple of minutes behind, but there is a break now. But before that, let me thank Dhanpal and Kathy, and if I may offer a small token of appreciation. Kalbhai? Yeah, thank you. Thank you. Thank you. Thank you very much.